Welcome to the deep dive. Today, we are undertaking a uh, really critical financial investigation.
Mm-hmm.
We're tearing apart one of the most common, and I'd argue insidious charges in personal finance, the overdraft fee.
Often paired with the non-sufficient funds or NSF fee.
Exactly. So our mission in this deep dive is to, give you the full picture
Right. We need to unpack the mechanics of how these fees even work.
and expose some of the, frankly, aggressive banking practices used to maximize them.
And then understand the severe financial consequences for consumers.
And most importantly, show you the modern, powerful alternatives out there right now that could permanently, well, short-circuit this whole debt trap.
It's so important.
For a lot of us, if you're lucky enough to have a cushion, an overdraft might seem like a simple $35 inconvenience.
A mistake you forget about.
Right. But for millions of households managing on razor-thin budgets, this is not a minor mistake at all.
No. When these fees stack up, they become a crushing burden that can push people into a real spiral of debt.
And the scale of this problem is just, it's often underestimated.
It is. We're going to dive deep into regulatory data from the CFPB, and it really details who exactly is paying these fees.
And what that cost means for their financial stability.
Exactly. And later on, we'll reveal a really compelling, kind of counterintuitive finding.
Oh.
Data shows that when just one highly aggressive bank practice was eliminated, a policy designed solely to maximize fees, it led directly to a significant 16% drop in local payday loan borrowing.
16%.
16%. That finding just flips traditional assumptions on their head. It shows you how deeply the banking system was intertwined with these, alternative finance debt traps.
Okay, let's jump right in. How are these fees even generated? What actually is an overdraft fee?
Fundamentally, it's a charge you get when a transaction exceeds the cash you have in your account.
Right.
And historically, the bank would cover that expense for you. It was like an emergency, very high-cost, short-term loan.
And you'd owe the negative balance plus this huge fee.
And that service fee is, it's astronomical.
We're talking, what, $34, $36 per incident?
At major banks like Chase, Wells Fargo, U.S. Bank, yes. But the real devastation comes from the stacking effect.
They're charged per transaction.
Per transaction. So you could make 3 small mistakes in one day, and you've already racked up over $100 in fees.
Okay, let's unpack this. The high-to-low reordering trick. This has to be the single most criticized practice they used.
It's a remarkable illustration of just engineering a fee mechanism.
So instead of processing my transactions chronologically, as they happen.
Right, in the order they hit your account. Instead, the bank would deliberately process the single largest transaction first.
And the effect of that is to, what, drain the account faster?
Exactly. It artificially exhausts your balance sooner, which maximizes the number of smaller transactions that then trigger their own individual $35 fee.
That just sounds so aggressive. Was there ever a public justification for that?
Well, the standard defense often centered on, risk management or efficiency.
Risk management for them, not for me.
Precisely. They'd claim they needed to clear high-value items first. But really, the purpose, as lawsuits uncovered, was pure revenue generation.
Which is why we saw places like Bank of America and Wells Fargo face huge legal penalties over this.
Yes, exactly.
Let's run through the Annie scenario to make this really concrete for everyone.
Okay.
So imagine Annie. She starts her day with a perfectly respectable $400 in her checking account.
Okay, $400. She has 3 transactions clear that day, a $50 electric bill.
$50 for groceries.
And then the big one, the $500 rent payment. Her bank charges a $35 fee per overdraft.
So under chronological, honest ordering.
The way it should be. The 2 $50 charges go through first. That leaves her with $300.
Then the rent hits.
Right. She's now negative $200 plus the $35 fee. So her final debt is negative $235. A mistake, but contained.
Okay, now let's switch it. High to low reordering. The bank's system.
This is where it gets ugly. The bank ignores the clock and processes that $500 rent payment first.
So she's immediately overdrawn by $100, plus the first fee.
The first $35 fee, correct. Now, the $50 electric bill hits an already negative account.
That's a second fee.
And the $50 groceries.
That's a third fee.
By simply changing the order, Annie now has 3 separate overdraft fees instead of 1.
And her final debt has ballooned to negative $305.
The bank just made an extra $70 in pure profit just by manipulating the sequence. It's a calculated mechanism.
And that's the stuff that keeps people in a constant state of financial peril.
Which leads us right to the profile of the frequent fee payer. And this is drawing heavily on CFPB data.
What's the scale we're talking about here?
Roughly 1 in 4 consumers, about 26.5%, live in households that were charged an overdraft or NSF fee in the past year.
But the real focus should be on this frequent overdraft group, right?
That's the one. It's about 18.4% of consumers, and they aren't just slipping up occasionally. They are cycling through these fees, and the data paints a very clear picture of financial vulnerability.
And you can see that vulnerability right away in their credit scores.
Immediately. For consumers in the no-fee group, the median credit score is strong, 769.
But for the frequent fee group,
It's 631.
wow, that's a 138-point difference.
Staggering.
Let's pause on that. A 631 score. What does that practically mean for someone? It's not just a number.
No, it means enormous strain. A 631 is fair, but it's dangerously close to subprime, which is below 620.
And we know a lot of them are in that category.
We do. 41% of the frequent fee group have a subprime credit score, and that limits their access to affordable credit for everything.
Car loans, mortgages,
Even sometimes employment background checks. They're paying higher interest on everything.
and their day-to-day liquidity strain. You can see that in other metrics too.
Absolutely. The frequent fee group has a median credit card utilization rate of 65.8%.
That's really high, way above the recommended 30%.
It indicates a heavy reliance on revolving debt. And even more telling, 42% of them report having zero available credit left on a credit card. They are stretched completely thin.
And there's a clear socioeconomic link here.
A very strong one. Households earning $65,000 a year or less are about 3 times more likely to be in that frequent fee group compared to those earning, say, $175 plus.
So these fees are really weaponized against the financially fragile.
That's a good way to put it. And the ultimate indicator is stability. A shocking 81% of consumers in that group reported having difficulty paying a bill at least once in the past year.
And what about their safety net?
It's almost non-existent. 71% of them could cover their expenses for no more than 1 month if they lost their main source of income.
And that explains why these fees persist. They can't afford to save because they're always paying off yesterday's overdraft.
Right. Only 8% of this group reports saving money regularly outside of retirement. It's a cycle.
So if we connect this to the bigger picture, we have to talk about the link between these fees and, well, payday loans.
Yes. There's been a long debate about that.
And the old assumption was a substitution effect, right?
Right.
If you ban aggressive overdrafts, people will just run to payday lenders instead.
It was seen as a trade-off. But the data from the early 2010s showed something far more complex.
What was the first clue?
Researchers noticed that banks using that high-to-low reordering were statistically more likely to have payday lenders and check cashers right nearby their branches.
So they were serving the same customer base.
They were already fishing in the same pond, which was a foundational clue.
But the real insight came when those aggressive policies were banned by lawsuits. How strong is that evidence?
It's remarkably robust. The analysis focused specifically on the zip codes served by the banks that were forced to stop high-to-low reordering.
Okay.
When those banks stopped the practice, their overdraft revenue went down, as you'd expect. But in those specific zip codes, borrowing from alternative lenders also dropped.
We dropped.
Significantly. Payday loans declined by 16%, and installment loan borrowing declined by 6%.
So the substitution theory is completely backwards.
It's totally contradicted. These aggressive overdraft policies weren't deterring the use of payday loans. They were acting as a complement.
They were creating the demand.
Precisely. That sudden, deep negative balance creates an emergency. When Annie goes from negative 235 to negative 305 overnight, she needs fast cash.
She can't wait for her next paycheck.
No, she's forced into the arms of a high-cost lender just to satisfy the bank's penalty. The bank was priming the pump for the entire alternative lending industry.
That is just eye-opening. Okay, so knowing how the trap works, let's pivot to defense. What does this all mean for you? Let's talk about immediate actionable steps to avoid this spiral.
The foundational strategy is control. Affirmatively opt out of automatic overdraft coverage. It is. For debit card purchases, it just means the transaction will be declined.
It's inconvenient, sure, but
But it means avoiding a $35 fee. Declining a $5 purchase is always cheaper than paying $40 for it.
And you can set up safer forms of protection.
Like linking to a savings account. The bank automatically moves money to cover a shortfall.
And they might charge a small fee for that, maybe $5 or $10.
Right, but that's a fraction of the standard penalty.
What about for budgeting?
We suggest a sort of modernized envelope system. Get a separate bank account or a prepaid debit card just for your discretionary spending.
Like for restaurants or entertainment?
Exactly. And, critically, opt out of overdraft protection on that account. When the money's gone, the card just stops working. No fees.
It's a hard budget line.
Non-negotiable. And as a general rule, just keep a cushion in your main checking account.
Those forgotten subscriptions.
Yes, the recurring payments that sneak up on you. Treat that cushion like it's a zero balance.
Okay, but a counterpoint here. If banks stop making all this fee revenue, won't they just raise monthly maintenance fees?
That's a fair question, and it speaks to their old business model, but the market has shifted dramatically.
Competition.
So much competition. If a legacy bank tries that now, you have so many viable, superior, fee-free options to switch to. That competition has forced the whole industry to adapt, which is great for you.
And speaking of adapting, if you do get hit with a fee, don't just surrender.
No, you can fight it. Call the bank. Be polite, but firm.
Ask them to waive it.
Especially if it's a rare occurrence. Cite your history as a loyal customer. Often they can waive 1 or 2 a year as a courtesy.
And if they say no,
don't give up. Be persistent. Hang up, call back, get a different representative. Sometimes that's all it takes.
But the real long-term solution is just moving to a fee-free bank.
That's the strategic move. And we're seeing traditional banks and fintechs competing fiercely on features now.
So let's compare a few. Ally Bank, for example.
Their spending account has 0 standard overdraft fees. They offer what's called cover draft protection up to $250.
And crucially, they give you a 14-day grace period to cover that negative balance.
That's perfect for someone who just needs a little flexibility.
Then you have Capital One 360 checking.
That's just a true no-fee overdraft service. Simple and clean.
Discover's cashback debit is great if you spend a lot on the card.
Yeah, 1% cashback, and they just decline transactions without a fee.
And for mobile-first users, Chime has that Spot Me feature.
Right, lets you overdraft up to $200 with no fees. Then there's Axos Bank, which combines no fees with a pretty strong yield.
Even the big guys are feeling the pressure. Truist now has a $100 negative balance buffer.
They do. So you really need to ask yourself what you need. Do you need cash back? Do you need that grace period? You can tailor your bank to your specific vulnerability.
So we've taken the dive. We've established that aggressive practices, like high-to-low reordering, were consciously designed to turn small errors into debt traps.
Preying heavily on those already struggling.
But the market has shifted, providing powerful alternatives to protect your money.
And what's really fascinating here is the ripple effect of curbing these practices. The analysis showed that when banks were forced to stop, low-income households didn't just save the money.
They spent it.
They immediately increased their quality of life. They used that money on essential goods like food and clothing, and on durable goods like home and auto repairs.
So removing the debt spiral wasn't just an accounting adjustment.
No, it provided liquidity for immediate life improvements.
That is a profound finding. It shows these fees were actively suppressing vital economic activity.
So much so that the elimination of these fees led to some high-fee bank branches being up to 2% more likely to close in low-income areas where that fee revenue dried up.
So we want you to take this knowledge, review your own bank-specific overdraft policy tonight.
Look especially at their rules for transaction ordering.
And ask yourself this single provocative question. Is your bank's business model fundamentally dependent on your financial vulnerability?
And if the answer is yes, the time to switch is now.